Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all those giant official documents that companies have to file. And if you appreciate getting straight insights from corporate documents, make sure you're subscribed. And if you want to join a community talking about these things, we have a Discord channel linked in the description below. Today we are diving into Teledyne technologies incorporated with their annual report filing, and get ready because we are about to decode some serious numbers and maybe a few headaches along the way. So we have Teledyne Technologies, their fiscal year ended the 28th of December 2025. And as you can see, their net sales hit a pretty impressive $6.1 billion. That is up by nearly 8% from the previous year, a solid gain in a pretty interesting market. Looking at the breakdown, their digital imaging segment continues to be their biggest earner, bringing in over $3.1 billion. This is their bread and butter. Sensors, cameras, all that high-tech photographic stuff that powers everything from industrial robots to medical scanners, and their aerospace and defense electronics segment saw a massive jump of over 36% in net sales, reaching about $1.06 billion. This is a super important growth area for them given the current global climate. Now, even though sales went up, their selling, general, and administrative expenses also crept up a modest 3.2% to about $931 million. Not a huge increase. So that is good, but it does eat into profits a little bit. But here is where it gets really interesting. Their operating income jumped by over 16%, reaching $1.15 billion. That is a significant improvement and shows they are not just selling more, but also managing their costs effectively. The digital imaging segment alone saw its operating income rise by nearly 20%, which is a fantastic sign of health. One thing to watch out for is the acquired intangible asset amortization that went up by almost 10% to $216.6 million. This is common when companies grow through acquisitions as they buy up patents and customer lists and have to account for that cost over time. And hey, in 2024, they had a $52.5 million impairment charge on acquired intangible assets, but importantly, that did not happen in 2025, a good sign. Their cost of sales as a percentage of net sales stayed pretty much the same at 57.2% for 2025 compared to 57.1% in 2024. This means they are maintaining their efficiency in producing their goods even as sales increase. And the bottom line net income attributable to Teledyne was $894.8 million. That is a healthy 9.2% increase from 2024, giving them a diluted earnings per common share of $18.88, a strong performance. Indeed. Now let us shift gears and look at the company's overall financial status. Looking at their balance sheet as of the 28th of December 2025, Teledyne's total assets reached a massive $15.3 billion. That is a substantial increase from $14.2 billion at the end of 2024. A big chunk of this growth comes from goodwill, which is essentially the value of their brand and customer relationships over and above the tangible assets they have AC. Acquired, that goodwill now stands at a huge $8.7 billion. Their current liabilities jumped significantly to $1.86 billion mainly, because their long-term debt has been reclassified, a common accounting move as certain debt comes due soon. But their long-term debt itself has actually decreased to about $2 billion from $2.6 billion in the prior year. That shows they are actively paying down their debts, which is always a positive signal. And the stockholders' equity, the value belonging to the owners of the company, stands at a very solid $10.5 billion. This is a healthy increase from $9.5 billion a year earlier, indicating a growing net worth for shareholders. Let's talk about cash flow, which is always a crucial indicator of a company's health. In 2025, Teledyne generated an impressive $1.19 billion in cash flow from its operating activities. This is the cash generated from their normal business operations. And they managed to maintain that same level from 2024, which is excellent news. But when we look at investing activities, we see a huge increase in cash being used $937.9 million in 2025, compared to $207.2 million in 2024. This is largely driven by acquisitions. They spent over $821 million on acquiring new businesses in 2025. That is a huge investment and shows their aggressive growth strategy. When we look at financing activities, they used over $555 million. This was primarily to pay down debt and repurchase their own stock, which is a pretty common way for companies to return value to shareholders. Now let's touch on the risk they are facing, because no company is without its challenges. They are upfront about the risk of a recession in the US or globally. This makes sense as many of their customers are in industries that slow down when the economy tightens. This could mean fewer orders and lower profits if things get tough economically. And then there are the risks associated with their aggressive acquisition strategy. They mention the difficulty in integrating new companies, the potential loss of key people, and even unknown liabilities. This is a big part of their growth, but also a notable risk area if not managed perfectly. They are also worried about rising costs for components, raw materials, materials, labor, and shipping these inflation pressures can squeeze their profit margins if they cannot pass those costs on to their customers. It is a constant balancing act in manufacturing, and the supply chain issues are still a concern. They mention past delivery delays and shortages of components and raw materials, and note that China has restricted exports of certain rare earth minerals vital for their products. This could continue to disrupt their ability to produce and ship goods. Given the current geopolitical climate, they are also concerned about global conflicts, especially between China and Taiwan and the ongoing situation in Ukraine. These events could disrupt their supply chains and affect their ability to sell to certain regions. In my opinion, Teledyne is playing a high-stakes growth game. They are clearly committed to acquiring companies to expand their reach and product portfolio. The massive increase in acquisitions in 2025 shows this aggressive push. Their operating income growth is strong, suggesting good operational management on their existing businesses. But the sheer amount of goodwill on their balance sheet and the integration risks associated with so many new acquisitions are definitely things to keep a close eye on. Their ability to manage these risks while continuing to innovate in their high-tech markets will be key to their continued success. It is a company that is actively shaping its own future through strategic moves, and that is always interesting to watch. Alright, that is our breakdown of Teledyne Technologies' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives, and don't forget to check out the Discord in the description. Thanks for watching. See you next time.